every single time. Hey, everybody. Welcome to Boss Blunt's Think Tank. My name is Marcel Kalinovic, the Butcher of Wall Street. You guys want to get this party started or what?
Let's do it.
Yeah. I say that's a good idea. What's up, my friends? How are we doing today? Thanks for coming out, everybody. We've got a couple of important subjects to discuss. Hello. Again, in case you missed it, my name is Marcel Kalinovic. I'm the Butcher of Wall Street. This is the next in a series of videos discussing the geopolitical and macroeconomic implications on financial markets by over-leveraged hedge funds. In addition, we will be talking the T+90 day settlement of payments in lieu of payments in lieu of dividends, as well as the possibility. We're going to ask the question: did Meet Kevin commit securities fraud? I'm not a financial, tax, or legal advisor of any kind. None of our views expressed in this video are financial advice in any way. Thanks everybody for coming out. Grandpa Barney, thank you for your support, my friend. You are too kind. Well, let's just get off quite simply to say that Meet Kevin from Twitter, &real Meet Kevin, says, I'm not sure I've come across clearly enough today clarifying. Ape is a shitty scam I call ape shit. If you buy and hold this ticker, you are transferring your money to the debt pay down of AMC. Since I own AMC, let me thank you in advance for being a complete idiot. These are all tweets, or most of these are tweets that Meet Kevin has since deleted. Here's a post in his Discord from Meet Kevin. He said on August 22nd, 2022, I'm more confident that Ape will go to $1 than I am that Tesla hits $1,500 before the end of 2023. I could be wrong, but I've never seen a ripoff as blatant as Ape before. About to post a video explaining. If Ape goes up though, it's very good for AMC shareholders, but it will likely still go under $1 and then to $0/delist. And as you can see, there's plenty of uneducated tool bags in his Discord that seem to be pretty thrilled about this. Real Meet Kevin said on August 22nd, 2022, note the date, August 22nd, I can't even short it right now. I tried, in response to CEO Glendon when discussing AMC and Ape. Mostly Ape. He continued to say, another date, that both of these are unequivocally false. I have no short positions on either stock. I now no longer own either. I do not benefit from any short ETF. I never purchased AMC stock to be part of its fundamentals, etc. Now, that's a funny one because he says he never owned that he does not benefit from any short ETF. Maybe not at the time, but he had an interest in an ETF, and I will show you that ETF that my man Edward Britchick here on the Think Tank found after finding out all this evidence about Meet Kevin. He said, Dear AMC community, on August 22nd, if you think AMC split today and that AMC being down 38% is okay because you have Ape that's worth around $7, be prepared to see that $7 evaporate. In my opinion, dump Ape. Buy AMC if you're an ape. And he follows up his financial advice by saying not financial advice. That's not how it works, Meet Kevin. I know you're watching this video. I know you're scared shitless. I know you've deleted all your YouTube videos that you posted up over the last several days and weeks in regards to selling Ape. I know you've deleted all of these tweets. And I know about your ETF. Well, looks like John Hempton, the short seller, who has been bashing AMC on Twitter for many, many months now, came out and asked Kevin a question to allow, or should I say, to give Kevin the opportunity to provide financial advice without squirting it out as just nonsense. He did it in reply to this tweet. John Hampton asked Kevin, can you explain what feature of AMC is not shared by Ape? For example, does one vote and the other not? I want to understand the differences. Meet Kevin said on August 22nd, yeah, the fact that if it doesn't convert, it gets diluted to under $1. Shared economic benefit matters if there is BK, bankruptcy, or economic benefit. We won't see either for a while. So enjoy Ape going to $1 with no guarantee of convertibility. Give a guaranteed convert at 1-to-1 and I'm in. Now, for those of you that are unaware, AMC has the ability to convert Ape into AMC, and they have had that ability since 2013 when this was passed by the board of directors and approved. We've done previous videos about that in depth, so I will continue. He said, John Hampton says, please, Kevin, I want to understand what you see and why you see it. And obviously, as you can see here, Meet Kevin's tweet was deleted. And here, Meet Kevin blocked Edward Britchick as well as the person who posted this on Reddit. John Hampton here agrees to shorting a lot of stocks. Here are the deleted tweets by the author, Meet Kevin. This information can easily be subpoenaed by the SEC to YouTube and have it pulled off to Twitter and have it pulled off the cloud anyway. As you can see, here's the reply from John Hampton to the deleted tweet. And there, as you can see, Edward's profile picture, and he's the one that was blocked by Meet Kevin. This, my friends, is the Tidal ETF Trust 2. Edward, who is the guy that this is based off of? Can you hear me, brother? Let me see here. Oh, look at this. My Discord is not displaying sound. Let me refresh. But while that refreshes, you guys can see here clearly on my screen that this was dated August 11th, 2022. And it was subject to completion. Hey, can you guys hear me now? No? There we go. Mic check. I know you can hear me now. We're back. Edward, who is this ETF based off of?
I mean, it says it right there, right? Do I have to say no more?
Absolutely right. On August 11th, 2022, this ETF was launched. There are going to be 3 Meet Kevin ETFs by the name of Meet Kevin All-In ETF, Meet Kevin Select ETF, and Meet Kevin Moderate ETF. This is Tidal ETF Trust 2. And as you can see here, these ETFs may or may not have an interest or a future interest in AMC. And you can look him up by name. Kevin Paffrath. Here will be the sub-advisor. Has been a portfolio manager of the fund since its inception in 2022. Michael Venuto will be the chief investment officer, and Charles Raugus will be the portfolio manager. Who owns Tidal ETF TR? The top investors of Tidal ETF TR stock are... Edward, would you like to?
Oh, yeah. Look at that. Jane Street and Citadel Advisors, with Sound Income Strategies being the top pick.
Well, ladies and gentlemen, the Tidal ETF TR here that we are discussing, the trust, is held by Sound Income Strategies, Jane Street, and Citadel Advisors. This is probably the Title ETF Trust 1 to the Title ETF Trust 2 that has recently been issued as of August 11th. So you can see that Citadel and Jane Street have a financial interest in Title ETF Trust. Quite a significant one, as well as Sound Income Strategies, Latitude Advisors. $316,000, $504,000, $15 million. And recently sold out. UBS Group recently sold out. Flow Traders, Global Wealth Management Advisory, and FMR. Who is this guy? Well, this guy is, let's go with Kevin Paffrath. This guy is Michael Venuto. He is the Chief Investment Officer for the advisor from Toroso Investments. And this is an article from October 24th, 2018, a video.
Right? So we have people like Burton Malkiel and Linda Zhang and a bunch of industry insiders that help us essentially tier which companies have the most pure revenue from ETFs. And
so this guy has obviously been doing this for many years and has quite an interest in this trust, this ETF here, I should say. Charles Raugus, also the Director of Product Management, it looked like, on Exponential ETFs. This is from May 1st, 2018. Foreside Financial Group is the broker-dealer, the distributor of this exchange-traded fund.
Looks like collusion to me.
I don't know if it's collusion. You could allege that. I have no actual proof other than everything shown here. But that would be for the Securities Exchange Commission to decide. I cannot make any... I'm not judge, jury, nor executioner, and only the Securities Exchange Commission would be able to decide if this was either insider trading or manipulation of markets, which carries a very hefty criminal felony charge. Foreside Fund Services out of Portland, Maine. This is their office. One Tower Plaza, I believe. One Tower East. Classy, baby. Keeping it classy. One Canal Plaza in Portland, Maine here. So that being said, Meet Kevin has been confirmed to have personal financial interests in the Meet Kevin All-In, Select, and Moderate ETFs, which are put out there by Title ETF Services. The broker-dealer distributor is Foreside Fund Services. The advisor is Toroso Investments. And as you can see, the custodian is U.S. Bank. These are the Edgar filings. There's also Rex Shares, New Short AMC ETF, which is Foreside Fund LLC. The same underwriter, Foreside Fund LLC, is facilitating Meet Kevin's new ETFs. He has not disclosed these severe and massive conflicts of interests. He actually told us the opposite. He told us that he does not benefit from any short ETFs, that he has no short positions on either stock, that Kevin stated that he never purchased it. That doesn't matter, but he did own it at one point. Whether he owns it now or not, I don't really care. The fact of the matter is that it very much appears, I have no proof other than what I've seen on the internet, YouTube that he's put out, tweets that he's done, of market manipulations. Now, these are just allegations. I have no actual physical proof. And I say that to shield myself of liability, although I do have fantastic attorneys. That being said, he put out plenty of YouTube videos, tweets, Twitter space calls, in which he attempted to coerce people into selling their AMC preferred equity unit dividends by the name of stock ticker APE. He has since deleted many of those interactions, as shown here, along the internet, which are still available on Twitter and YouTube. They would just have to be subpoenaed in order to receive those. And if anybody wanted a more clear-cut case of influencers being, well, maybe not paid, but given a partnership, either directly or indirectly, to push fear, uncertainty, and doubt, this is one of them. As for Meet Kevin, good luck, my friend. Good luck. Don't drop the soap. Now, let's move on to more important subjects. But first of all, before we do, I would like to give a massive shout out to Edward Britchick. Thank you very much, brother, for bringing up all this awesome due diligence on this ETF and the situation that's occurred here with Meet Kevin, because this is this looks terrible. Let's put it that way. This looks absolutely terrible on his part. And if I were him, I would be extremely concerned about the SEC breathing down my neck. That being said, I've said his name one too many times, and I have no interest in talking about that fool any longer. Meet Kevin, go fuck yourself. Gary Gensler, I want my fucking whistleblower money.
Let's freaking go.
Let's move on. Now, T+90. Why is it that so many people do not understand T+90 days? It is it's quite a difficult thing to understand. And this is due to substituting the payment in lieu of dividends. And this occurs in connection with the short sale of stocks. Basically, if shares are sold short, the shorts have to pay the dividends. If these are APE and they don't have APE to deliver, payments will be made in lieu of those dividends from the fact that your broker lends the shares that you own to short sellers when you sign up for their share lending programs. Maybe it may or may not apply to you directly. I'm just speaking generally to people that are in these share lending programs that own AMC or APE. These short sellers borrow their shares and sell them on the open market, relying on the fact that they'll have a lower value before having to repurchase them and return the shares. If the security pays a dividend in the period that it was borrowed, the short sellers must repay that lost dividend income. This refund is the replacement payment made in lieu of profits that would otherwise have been received directly by the issuing corporation. And this would be from Computershare to the DTC to the broker-dealers. Then from the broker-dealers to the short hedge funds, and they have 90 days to return them or to close out their positions or to be liquidated. So to sell short, the merchant to the short hedge fund must borrow the shares of a broker, the broker-dealer, such as Interactive Brokers. Can you guys see that on my screen? Sure you can. Excellent. I have been trading with Interactive Brokers for many years. And they have been in business for many years, and they are a very reputable company. That being said, they were embroiled.
Brokers founder and chairman Thomas Petterfy. Thomas, good to see you again. Thanks for joining us. My first question is, are you surprised and or disappointed not to be a part of the hearing tomorrow?
Let's put that on hold for 1 second because we need to finish what we were discussing here before I wrap this point around. So the broker-dealer like IBKR, pull this over here. Has quite a lot going on here, guys. Bear with me. There's payments in lieu of a dividend. It's a term commonly used to describe a cash payment to an account in an amount equivalent to the ordinary dividend. Generally, the amount is paid is per share owned. In addition, the dividend in most cases is paid quarterly, but whatever, that doesn't really matter. These may be received when the shares have been bought on margin or when the account has subsequent margin loan due to borrowing money to facilitate the payment for additional purchase of shares, or as the result of a withdrawal from the margin account. Payment in lieu of a dividend may also be received when shares are owed to the brokerage firm and have not been received by the dividend record date. How many people did not get their dividend paid on time? How many of you guys did not receive APE on August 22nd? Let me hear that. Let me see that right now in the chat. I want to see this chat box start scrolling, and I want to see how many of you guys did not receive it on time. Because that's something I've been wondering about. You were supposed to have it by August 22nd. They continue to say, here, I'll start here. There's a guidelines above for the segregations of securities that are clear. There are exceptions that are outside the firm's control. For instance, through no fault of its own, Interactive Brokers may have a deficit in segregated shares due to a customer activity that changes the firm's overall segregation requirement for a security. This means the amount that they hold and the amount that they need to hold. This may be for a variety of reasons, including a delay in receiving shares that have been loaned out to a counterparty after segregation requirements are recalculated and the firm has issued a stock loan recall. Recall. That means they're forced to give back the shares to the broker-dealer. Sales of securities by one or more customers that reduce or eliminate margin loans. The deposit of cash by customers that similarly reduce or eliminate margin loans. Or a failure of a counterparty to deliver shares for a trade settlement. This would be a failure to deliver, ladies and gentlemen. Wow, that's a lot of people that had their ape arrive late. And Chris, the ape, thanks for your contribution to the think tank, my friend. Upon issuing a recall of shares loaned, rules permit the borrower of the shares up to 3 business days to return them. So after the 90-day period, there could be an additional 3 business day period in which the short hedge funds would have to return these failed to deliver shares that are being recalled. The APE dividend, in my opinion, was designed to squeeze in around 90 days, specifically. The borrower of the shares is required to return them to us when we issue a recall, says IBKR, but if by business day 3 the shares have not been returned, IB may then issue a buy-in notice to begin the process of regaining possession of the shares. This means manually. This means short hedge funds and shorts are fucked. An additional 3 business days is generally needed for the purchased shares to settle and be delivered to the firm. So that's 96 days now. Similarly, if a counterparty fails to deliver by a settlement date shares to Interactive Broker to settle a customer price, IB can issue a buy-in notice. But the purchase of such shares are also subject to trade settlement in 3 days. To summarize, if by the record date of a dividend, certain shares have not been delivered to IB, the firm will be paid an amount of cash that is equivalent to the dividend amount, but IB will not receive a qualified dividend payment directly from the issuer. In such cases, the firm will receive payment in lieu and will have no choice but to allocate such payment in lieu to customer accounts. The firm first allocates payment in lieu to those accounts who hold the shares as collateral for margin loan. If after the payment in lieu is allocated to all shareholders whose accounts are not fully paid, any portion of PIL remains to be paid, it is allocated on a pro rata basis to each remaining client account. They may have different tax consequences and should consult a tax advisor. None of this was financial or tax advice of any kind, simply stating what my opinions and what IBKR states. The special dividends process. What happens if my account is subject to a margin deficiency when a reinvestment occurs? If your account is in a margin deficit and can't initiate new positions, dividends will not be reinvested, even if you have it enabled. Please note that these orders are blah, blah, blah. Should an account go into margin deficiency at any time after that, including as a result of the end of day SMA check and the end of day soft edge margin, the account will become subject to automatic liquidation. Thank you very much, IBKR.
Oh yeah. Everybody rich.
That's right. Now, the downside here, the whole point of payment in lieu rather than dividends is to supplement the original shareholder. However, they present a disadvantage. They cannot benefit from tax quotas to obtain qualified dividends. Currently, eligible dividends have maximum rates ranging. However, they still have at least 10 percentage points of the tax rate paid. Payments in lieu cannot benefit from this favorable treatment and are taxed on ordinary income. So how to prevent payments in lieu? There's a way to make sure that you never have to make substitute payments instead of dividends. Choose a cash brokerage account instead of a marginal brokerage account. In a cash account, your broker cannot use your shares to lend to small sellers unless you give them permission, which prevents the payment in the place of the situation. Instead, a margin account usually includes provisions allowing the broker to borrow your shares at any time. This is from the DTC. And regarding the security types, the DTC announces corporate action events for security types, including but not limited to the following. The following distribution events are covered in the functionality described below, including liquidation based on record date holdings, the exact same thing we were talking about. This is from FINRA. This is Rule 4314, Securities, Loans, and Borrowing. Disclosure of parties' capacity in loan or borrow transaction. A member that lends or borrows securities in the capacity of agent shall disclose such capacity to other parties of the transaction. Being the broker-dealer, the agents, all the middlemen involved there, and the market makers. Prior to lending securities to or borrowing securities from a person that is not a member of FINRA, member shall determine whether the party is acting as a principal or agent in such transaction. Now,
Yeah.
hold on one second. There's the likelihood that the DTCC owns the stock in their name, that you have basically paid beneficiary rights to, but because they are the legal owners of the stock, which they received, the DTC received it from ComputerShare for Ape stock, they can do whatever they like with it, such as lending every single share they have on the books to short sellers, regardless if your broker-dealer account is cash or margin. And because this is the case most of the time, you are likely not entitled to bona fide dividends. So this is actually pretty interesting information here because I cannot say for sure that that's happening, but in theory, that's exactly what the case is, because the broker-dealers do have certain rights to borrow your shares based on your written agreements that most people don't read, and the DTC also can do pretty much whatever they want with the shares as well. The right to liquidate transactions of the member that is a party to security loan or borrow transaction where the other party to such transaction is acting as such agent shall maintain books and records that reflect the details of that transaction and each principal on whose behalf the agent is acting. This gives the FINRA the right to liquidate the transaction and the broker-dealer the right to liquidate the transaction, like IBKR, to short hedge funds or to retail shorts. Each member that is party to an agreement with another member providing the loan and borrowing securities shall have the right to liquidate such transaction whenever the other party to such transaction applies or consents to or is subject to the application for taking the possession by receiver, custodian, trustee, or liquidator of itself, admits in its writings its inability or becomes generally unable to pay its debts as such debts become due, margin calls, and in my that's my little dropping in of information there. Back to the subject. They make general assignment for the benefits of its creditors, or files or has filed a petition under Title 11 of the United States Code for a protective decree under Section 5 of the Securities Investor Protection Act of 1970, unless the right to liquidate such transaction is stayed, avoided, or otherwise limited by an order authorized under the provisions of SEPA and any statute administered by the SEC. Blah, 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 blah. Okay? You get the point here. When a member borrows securities from a customer, the member is also subject to this rule. The member is subject to Rule 4330 B2BII, which requires members to provide disclosures to customers regarding these risks and financial impact. This is not good for short hedge funds in any way whatsoever. This is obviously, as you can see, this was also directly from the DTC Corporate Actions Distribution Service Guide of June 30th, 2022. And what this leads us, in the case of a dividend-paying stock like AMC with the APE dividend, a broker-dealer may refuse to lend shares to customers on the day of the dividend distribution and may withdraw dividend-paying stocks from short sellers. This is a share recall. The broker has the right to require a short seller to repay the borrowed shares sold. So the broker can require the short seller to repay those borrowed shares at any time, especially if they fail to deliver after 90 days of making payments in lieu. Some brokers will pay credit on account of an investor who has received a payment instead of offsetting the difference by paying a higher tax rate. However, AMC has already said that APE will not be paid in cash in any way, and they will only be paid to people via an APE dividend. That, ladies and gentlemen, is why the Federal Reserve will continue to bail out the banks, because the vast amount of people that are invested in AMC, APE, GameStop, BBIG, MMAT, and many, many other meme stocks that may or may not have yet issued their dividends, many broker-dealers, prime brokers, market makers are going to need a bailout. And we already know that the Fed continues to lie about bailing out big banks. We were told that the Federal Reserve would not buy bank debt, and they created a loophole using exchange-traded funds so the Fed can buy bank debt to bail out big banks. In the same way that these exchange-traded funds are used for banks' debt to be purchased by the Federal Reserve, exchange-traded funds like the REX Short AMC ETF can be used to short AMC when there are no shares of AMC available to short.
This is a headline from Bloomberg. Despite stated exclusion, the Fed is buying bank debt. Would you like to revise your statement about your earlier answer when I asked you whether or not the Fed had purchased bank debt as part of coronavirus relief?
No, that answer was entirely accurate. We have not purchased bank debt. We purchased ETFs. Those ETFs,
ETFs and contain bank debt?
The ETFs contain a portion of bank debt. We stopped buying the ETFs several months ago. It was important to buy the ETFs in order to jumpstart the general process of restoring the economy, which has benefited everyone.
So what happened here is you said you wouldn't buy bank debt. Then you crafted a loophole using ETFs so the Fed could buy bank debt, a loophole buried in a subparagraph of rules on the Fed's website. And this loophole essentially swallowed up $2 billion in taxpayer money during COVID to bail out big banks, even as you told the public that the money could not go to any bank. This is a headline from
A failure to deliver on APE that was sold and not delivered would in default be a payment in lieu, covering the dividend, and it would become a failure to deliver or for a borrowed share. There are only 516 million APEs issued. Everything else would be synthetic. And we've all seen all those screenshots and seen them on our own brokers of 700 something million, 50 billion, and other everything in between APE shares outstanding on various broker dealers. These APE shares have a default T+90 clock, basically, as my friend Houston Wade stated so eloquently. If the short hedge funds don't provide real APE to replace the synthetics at 90 days, they get liquidated and forced to buy them. It's the entire reason APEs were created. That, my friends, is why the Federal Reserve and Jerome Powell are going to have to get the fucking money printer out. And it's also why the IRS hired 87,000 new IRS agents, in my opinion. With a combined salary of 87,000 new IRS agents, with an average annual salary of $81.4 thousand, you could put a police officer in every public school in the nation and still have 31,007 police officers, or $1,709,000,000 left over. Now you know they're not interested in your safety. They're interested in coming after people like you and me, small business owners, entrepreneurs, everybody in between. The bottom 99%. And many of you have heard, if you have not, Thomas Peterffy speaking on the GameStop event. And he was asked a question in regards to the GameStop lawsuit. But we all know that on January 28th, 2021, Robinhood and dozens of broker-dealers around the world pulled the buy button and prevented retail from buying AMC and GameStop because this would have broken the system. Here's Interactive Brokers CEO Thomas Peterffy. This man has more years in the financial industry than most of us have been alive, with some exceptions.
Oh no, I'm neither surprised nor disappointed. This is just fine with me.
Just fine. I can imagine. So what do you think will be the focus? Because there's lots of angles here, whether there was insider trading, whether the likes of Robinhood hurt their customers, and whether the likes of Citadel are abusing their power. What do you think is the key focus and the likely outcome?
Citadel.
So what I would like to point out here, that we have come dangerously close to the collapse of the entire system, and the public seems to be completely unaware of that, including Congress and the regulators. So let me explain to you that on January 26th, Game had closed at $77 a share. The following day, it closed
on January 26th, GameStop closed at $77 a share. The following day, GameStop was $148.
The following morning, on January 28th, the stock opened at $355 and traded up to $480. At the same time, Game had 50 million registered.
GameStop had 50 million registered
shares outstanding.
50 million registered shares outstanding.
And the short interest of 70 million shares. In addition, there were about 1.5 million calls, which would call for 150 million shares.
A call contract is underlying of 100 shares. So the call contracts that he mentioned are an underlying of the asset of GameStop that he's discussing right now of an extra 150 million more shares, in addition to the net deficit of 20 million shares that were owed.
If the shorts the longs repay their margin loans and exercise the calls,
if long holders of these calls exercise their call contracts,
their brokers would have been obligated by the rules as they are today to deliver to them 270 million shares, while by only 50 million shares existed.
if retail investors, would have exercised their call contracts, the broker-dealers would have had to deliver 270 million shares when only 50 million shares existed. You can't have that without naked shorts and synthetic shares, ladies and gentlemen.
So when the shorts cannot deliver the shares, the broker representing the longs must, by the rules of the system, go into the market and buy the shares at any price.
At any price, they must go out and buy the shares if they need to cover the short hedgies positions. And that's the same reason why they have this information here stating that the account will become subject to automated liquidation. The same reason they give us these overviews of dividend and payments in lieu, because they have 90 fucking days to deliver, or the broker dealers will have to get them at any price, and that means they're going to have to go get that money and that collateral from the short hedgies by liquidating them.
Here we
Pushing the
go.
price into the thousands.
Pushing the price into the
Shares
thousands.
of any go into the system, go into the market and buy the shares at any price, pushing the price into the thousands. So as the price goes higher, the shorts default on the brokers. The brokers now must cover themselves. They push the price further up. So the brokers default on the clearing houses, and you end up with a complete mess that is practically impossible to sort out. So that's what almost happened.
Jerome Powell, get the motherfucking money printer out.
To avoid this in the future, the SEC needs to immediately
Boo,
call
boo,
for reporting
boo.
of short interest on a daily basis, because they are currently only reported twice a month. And
This man is telling us that the only way to stop this would be to force the reporting of short interest on a daily basis instead of twice a month. This would prevent the manipulation of the short interest numbers, in which they're currently being heavily manipulated through rehypothecations, shorts marked as long, married puts, married calls, divorce puts, divorce calls, and I could keep going through wash sales and spoofing, and I digress.
I think they should increase margin requirements on shorts by 1% for every percent of short interest. That would solve the problem. This is a gaping hole that didn't have before, because short squeezes are considered market manipulation, which is illegal. But so therefore nobody did it. But with these social platforms, people can just chit chat, and suddenly a short interest emerge without pointing at any one person.
Hey, we're not shorting the stock. I'm just buying a stock that I love and holding on to it. It's not my fault that it's being manipulated to high hell. I'm not manipulating it. I'm just buying it.
Who is guilty, right?
So Thomas, I mean, it's extremely complicated, and they'll have to try to explain all this market structure in between some of the populist grandstanding from members of Congress tomorrow. But ultimately, who are you saying is to blame, if anyone, for what happened?
No, it's nobody. Nobody is to blame. There is a hole in the system that we immediately have to stop.
The short interest only being reported twice a month is easily manipulatable. Easily. And it's a hole in the system that we, as retail, cannot abuse. Only the people in charge, market makers, short hedge funds, prime brokers, people that can buy and sell short, that can trade ISDA contracts, futures, swaps, and total equity return swaps to be able to manipulate these things.
There's a hole
Which
in
is
the
short interest reporting?
short squeezes. Sorry?
You're saying that is the short interest reporting. That's what was happening here? That was the problem?
No, the problem was that there is no increased margin requirements on shorts as the short interest increases. As a matter of fact, most people don't even know what the short interest is because it's only reported twice every month.
What portion, Thomas, of your trading is payment for order flow? I know it's a smaller percentage than some of your rivals.
It's like 3%.
Shepard Smith.
So there you have it, folks. Thomas Peterfy, the Chief Executive Officer of Interactive Brokers, has clearly told you exactly what happens during short squeeze and why short interest, the reporting of it, and the lack of daily reporting with margin increases is allowing manipulation to occur. The everything bubble leads us to market, equities, and real estate crashes. Inevitably, the Fed will have to print more money, leading to further hyperinflation.
From Bloomberg,
and then they'll lie about it.
Despite stated exclusion, the Fed is buying bank debt. Would you like to revise your statement about your earlier answer when I asked you whether or not the Fed had purchased bank debt as part of coronavirus relief?
No, that answer was entirely accurate. We have not purchased bank debt. We purchased ETFs. Those ETFs,
and we contain bank debt.
The ETFs contain a portion of bank debt. We stopped buying the ETFs several months ago. It was important to buy the ETFs in order to jumpstart the general process of restoring the economy, which has benefited everyone.
So what happened here is you said you wouldn't buy bank debt. Then you crafted a loophole using ETFs so the Fed could buy bank debt, a loophole buried in a subparagraph of rules on the Fed's website. And this loophole essentially swallowed up $2 billion in taxpayer money during COVID to bail out big banks, even as you told the public that the money could not go to any bank.
Absolutely.
This is a headline from Bloomberg. Despite
even Dave Lauer, former Citadel employee, if I recall correctly, says, I continue to believe that leveraged and inverse single stock ETFs, especially on highly volatile names, are a steaming pile of trash. They're a terrible idea and have no place in our markets. They further the perception of the markets as a casino. Add leveraged and inverse single stock ETFs to the steaming pile of trash. He said there's no consistency right now from the SEC in approving these products, and investor protection seems to be an afterthought. I'll leave you with that, ladies and gentlemen. They're absolutely desperate, okay? Absolutely desperate, in my opinion, to come out with new ways to short AMC because they're deathly afraid of what's going to happen. On that note, I wish you all peace and wealth. Thank you for joining us. I'll leave you with a song. Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. I almost forgot. Before I could forget, I'm very much looking forward to what's going to happen on APE and AMC. There's no time frame or date that I can say specifically, but we're looking around November 18th to November 22nd for the T+90 days. Then there may or may not be additional days. So if any of this could possibly be true, theoretically, then there might be price action. It might be delayed further. It might be kicked further. I don't know, but I'm not I know where my conviction lies, and I don't really care how long this takes. I believe that a stock market crash will lead to a lack of collateral and margin calls that inevitably will lead to a mother of all short squeezes. It's really quite simple stuff. This is all theory. It's based on my understanding and past history, but past history is not always indicative of future performance. That being said, I'm not a financial advisor. Do your own fucking due diligence. I wish you peace and wealth. Thank you, my friends. Just for the record, they do count weekdays on T90.